Welcome, ladies and gentlemen, dear traders around the globe. We from Admiral Markets say welcome to our Admiral Markets weekly market outlook with Jens Klatt and also with me. My name is Tim Tamp. I'm a sales guy from the German office, and we do this webinar in co-moderation. And in this webinar, where, as the name said, we would like to have a look out what's going on at the markets last week and maybe the next weeks. I'm searching here for maybe interesting setups and for sure answering here your questions. But first of all, here are our risk disclaimer, so please be aware that all we are showing and presenting here today is just a personal opinion of our traders and not an advice for investing. So, and yeah, here is additional risk disclaimer because of the new ESMA regulations, and so maybe you know about it and heard about it. Retail clients and professional clients, these are the new groups for you. Especially here is the slide. So here you can see it on the right side. What does it mean with the leverage? Because the leverage is reduced from maximum from 1 to 500 to maximum of 1 to 30 for you as a retail client. But you have also the options, to change maybe here for professional client. Here on this slide, you can see some of the options or what does it mean. And for sure, we have all this information on our website as well, if you like to go more in detail. And for sure, you can contact us if you have additional questions about this topic with the ESMA or all other things you would like to ask us about. So, and additional, this is a live trading session, so this webinar is recorded and you can find it later on our YouTube channel. So that's for the moment for me. Here's a picture again from Jens. Hello Jens to you again. Hope you're doing well. I share you the screen and you can start.
So yeah, hello, and also welcome from my end. By the way, I'm also located in Germany, so in my case, it's an early good afternoon. Even though I'm aware that probably also some people, let's say in Tahiti or something, will listen to this right now. Even though I think it's midnight there, so probably not necessarily at Tahiti. But wherever you listen to this, I just hope that in the upcoming 40 to 45 minutes, I can give I can give some value to your trading here. What we will do, Tim already mentioned it. We want to have a look back at last week. That's probably very, very interesting because some of the thoughts we presented here last Friday were already triggered, and currently this is always a great thing for an analyst, but also a trader, sure, if it works the way you expected it to work out. And nevertheless, there's also something also very interesting happening right now in gold. We want to have a look then here on gold and what to expect in the upcoming trading week. In fact, I've already brought up a trade. Probably I'm a little too early, even though I think the current region is probably very interesting for anti-cyclical aggressive long engagements. But let's make a look back here, in this case to GBP CAD first. Very exotic currency pair. Nevertheless, a very interesting pattern, which came to the surface last week already on Friday. Therefore, I just want to go back here to the website from Admiral Markets, and there on this weekly market outlook, the written one, which is which was published in this case on August 6th, so on Monday, you can find these thoughts here, not only in a recorded version of this video, but also in written format via analytics and then the traders blog. This is also where you find several other articles, for example, around trading setups based on some webinars we did in the past, open range breakout, this on the DAX, on the S&P, but also here, for example, the pros and cons of scalping versus day trading versus swing trading. So it's a very, very interesting section on the website from Admiral, even though we want to focus here on the weekly market outlook, and therefore scroll down to the section around GBP, respectively around the CAD, and especially at this paragraph here, in fact, the last one before the article ended, in fact. There was something I mentioned during the time span from the 7th of August till the 13th of August. So we are still within this time span, but the trade will end then on Monday at the end of the trading day. And so far, it seems as if the trade will show a profit. Let's hope that the current weakness in GBP continues. And if GBP is capable of stabilizing, probably because of some good GDP data which came out today, which we want to have a look at a little later on then. Probably the CAT also can perform well and probably, yeah, show some further trending momentum, let's say, on the downside. So what I mentioned here already last week on Friday, but then also again here in written form on Monday, was that from Tuesday onwards, within the time span from the 7th of August till the 13th of August, during the last 23 years, in 19 of these cases, that's 83% then, GBP CAT traded lower for whatever reason. It's just a seasonal pattern which happens to over and over again, and is, that's why worth mentioning here. It traded lower during this time span with an average gain of 187 pips and an average loss of 79 pips, a maximum loss here of 115 pips. And so the combination of this seasonal pattern plus also the fact that GBP last week on Thursday already, after the announcement from the Bank of England, showed a very, very weak reaction. We remember there was a rate hike from the Bank of England. That was nearly certain that this would happen. Meaning the swap markets already saw a chance of a rate hike of the Bank of England by over 80%. And then I said, well, probably GBP will nevertheless see some weakness because of the Bank of England doing something we call a dovish hike. So meaning they hike rates, but this is something which is expected. So it's no real new, really a news to the markets anymore. And what's more interesting is what to expect afterwards. And there was something where I said, well, the uncertainty around the Brexit negotiations, for example, some slack in the economy, especially in the employment section, especially in terms of wage growth, for example, all this is usually something which makes it unlikely that the Bank of England will follow with further rate hikes in the future. And the complete opposite happened. They said economy is strong, there's a good momentum in the employment situation, or around the employment situation. There was an unanimous decision from the MPC, the Monetary Policy Committee. They said with a decision of 9-0. So there's 9 members who have a vote here, 9-0. Yes, we need a rate hike. Plus, on top of that, in the statement, it read that the MPC also agreed on further rate hikes in the future. So it was the complete opposite of a dovish hike. Nevertheless, pound sterling sold off, and towards the US dollar fell below 130. That was, in fact, a very weak reaction. And something which underlined that probably this seasonal pattern is probably an interesting, good point to start, or probably start a short attempt here in GBP CAD. And this is exactly what we did. And 1 second, please. Where's the cursor? There. So I decided to take a short here then on Tuesday. Some of you probably recall, there was also a webinar, a short one, even though it was a short one, but it was the real trading ideas. You can also register for this webinar series, by the way, on the website from Admiral Markets. And so I presented the trading idea there. The only problem we have with such a setup then, even though we have a time span within, we expect weakness in GBP CAD, and that's why we're working with, let's call it a time take profit. If the trade shows a profit, respectively, a point at which we take out the trade then, which will be then next week on Monday to Tuesday, so into the end of Monday. Let's just see how the opening of the trading week happens. The only problem is, okay, where to place the stop, because what you can clearly spot is that the market already broke here the region of those May lows, and took on serious momentum on the downside. And from a price action perspective, when something like this happens here, and you can see it here, first progression, there's a regression, and then the market is following with the next progressive move here, breaking former lows. This is something where we then say we are now entering the so-called distribution area. And the usually you assume when something like this happens that the risk reward for a trade starts to become a little unattractive. Plus, on top of that, or that said, I mean, from a market or price action perspective, stop loss would have been here somewhere around 177, 78 around. And if you're entering the market, as I did here, and as you can see here at a 69, well, we're talking about a stop of 800 pips, which is probably a little too much, especially when taking into account that the average gain for the seasonal trade was around 200 pips. If you round it up, it's in fact only 180. So we are talking about potential risk reward then of only 0.25 to 1, which is very, very unattractive. This said, you try to find another way to position to position yourself in this case, and respectively to set your stop. And what I then did was I said, okay, where's this? It was around 78. Did we say pips? The max loss was 115. So we are probably good if we say we work with a stop of 2 times the ATR, in this case 200 pips. This is exactly what we did then. So entering the market, let's round these numbers down, in this case to 69, and round here the numbers down to 71 in this case. So 200 pips away from 169 where I entered the trade. So the stop then can be found at 171. So far, market is obviously moving in our direction. Currently showing a profit, which is really nice. Currently showing a profit of, in fact, nearly 200 pips. So the payoff is around 200 pips. Something worth mentioning in this case is that the positive expected value, so the profitability of this trades, comes with the fact that the hit rate can be expected to be around 80% here. So if you have then a payoff, in this case of 1-to-1, the trade is obviously very profitable because of the high hit rate of this pattern. And yeah, so that's it on the trade. So a very detailed idea, even though the trade itself manages itself, if you want. So you enter the trade, you set the stop, and then you just wait 1 week and see if the seasonal pattern plays out or it doesn't. And in this case, obviously it does. And hopefully we'll see a nice profit then on Monday when we close out the trade. And I'll just give you an update then on the profit of the trade next week in our webinar, the next weekly market outlook we'll have here. So that's it on GBP CAT in this case. And now what I want to do before I start talking about this trading idea here on gold and my thoughts, by the way, also from a seasonal perspective, very, very interesting what's happening here. We probably start first with an outlook on what's currently happening in the markets, and in this context, looking at Euro USD. I bet that most of you will finally or already have seen it. We broke lower here and fell below 115 in Euro USD. So we broke out of this trading range, which we also made a topic in the last weekly market outlook. And that said, there is some good reasons to believe that this is not only a fake out on the downside, but probably that Euro USD will take on further momentum on the downside and probably go for 112, even though this completely contradicts what I will tell you about gold, since we know that gold, for example, is negatively correlated to the US dollar. Or put it another way, if the US dollar is expected to strengthen, you usually shouldn't expect gold to strengthen here too. This is something which is really very interesting right now and showing that the situation is not 100% clear. But we want to focus on price action only here, and the fact that Euro USD broke below 115, fell to new yearly lows is a clear sign that we should expect further weakness to come. This is probably especially true since if you look at the so-called commitment of traders report, I've prepared it already here. In this case, it's for gold, but let's go back and, oh, I'm sorry, that's not optimal. 1 second, please. I thought that here. Okay, so the website is bar chart. It has a very, very nice way to show all these data around the commitment of traders report and the positioning of the big speculators. Unfortunately, it takes a little for whatever reason. So if you click on futures here at the commitment of traders report, you are guided to a site where you can find the commitment of traders report and the big players positioning. in many other assets here, or in many markets. For example, gold, something we want to have a look at later on, but also the US dollar index, and also, for example, here the Euro FX, so the Euro future. Probably we skip this and we go straight to the US dollar index. But what I can tell you is if you click through all these currencies which are traded against the US dollar, you will find out that the euro is the only currency which is currently long, net long, where the big speculators are net long against the US dollar. Let's see what happens tonight when the CFTC releases the update on the Commitment of Traders report. But if you here take this into account, this net long positioning, and you combine it with the fact that currently the US dollar index future, for example, broke significantly higher, which you can see also here on this chart. So we broke above this region, which I mentioned several times before, 95, 95.30, which goes usually hand in hand with the break low in Euro USD, below 115. The reason for that is because the euro has 58% of the basket here against the US dollar. So usually it means if the euro breaks lower, or if euro shows weakness, then usually should expect US dollar to go higher and the other way around. So the thing is that you can see in this case that here in the US dollar, we can see the highest net long position of big speculators since 18 months and more than that. So the last time we've seen such a aggressive net long positioning is around, something like 1 year ago. So that was around here during this strong trend on the downside. And again, the euro presents itself still net long against the US dollar. That said, you usually should expect after this significant break higher in US dollar, and the quite significant break lower in the Euro USD, because this is definitely a very significant region, 115, you usually should expect further selling pressure to come into the market and drive the Euro USD lower. That said, the current bias is clearly bearish euro, and next week, short setups should definitely be favored in my opinion. So what you should go after is the classic sell the bounce if you want. So defining a structure of falling highs and falling lows. Let's, for example, take here the hourly chart. In this case, you can see we've seen some very choppy, some very unspectacular trading happening here. Now we broke lower, and this is the potential trigger line for short engagement. So that's that. Let me just give you, even though it's a very rough way to illustrate it, but nevertheless. So it's Euro USD on an hourly chart. Probably it's worth, where is the cursor? There. So it's one, let's do it here. It's an H. So it's 1 R, it's 1 hour here in this case. And here the former lows, this is exactly where the line in the sand can be found. So potential short trigger in Euro USD can be found around 115 to 115.30. So it's very rough. I'm sorry. Hopefully you can read it, but I think so. It becomes clear. Former lows 15 around 15.30 is the line in the sand here as a potential short trigger, and everything below in this case 116.30 to 116.50 can be considered from an hourly perspective to be bearish in the Euro USD. So 115 to 115.30, this is a very interesting region against which short engagements are potentially very attractive, and something to look out, or to look for in the next week of trading. So we are drawing a quite bearish picture for the Euro USD. So what we also know is that there's a high positive correlation between the euro and pound sterling, so GBP. We already mentioned GBP at the beginning, and we can assume that we have probably some further room to go on the downside. It's not only that we are now that we went for the target, which I mentioned several times before, around 27.50 to 28 after the break below 130, but probably we should extend this to a lower level, probably to the region here around 126, probably slightly below that level. So and the driver is not necessarily only the positive correlation to the euro, but also the still difficult negotiations around the Brexit. We still do not know in which direction in which direction here the a negotiation will come out. Will it be a soft Brexit? Will it be a hard Brexit? So no deal at all. Even though if it's a soft Brexit, which we are going for, the price for the economy it has to pay is still significant, and probably a downturn from an economic perspective should be expected, based on which no further rate hikes should be expected from Bank of England, meaning that the overall outlook also for a longer time frame, not only for one trading week, but probably several months to a year from now, is not very positive for GBP now anymore, especially after, obviously there's also trade war fears building in the markets, everything which weighs potentially on the economy, on the UK economy in this case. So in this context, probably it's worth to mention that next week there's also two data sets which could be very, very interesting. By the way, I forgot one for the euro, something I will just deliver in a few seconds then after we work through GBP here. A potential further driver for weakness in the euro. But first, let's focus here on pound sterling. So next week on Tuesday, we have the unemployment rate. And then here on Wednesday, probably even more important, the inflation rate. So if the numbers come in below expectation here, it would mean, or it could trigger further weakness in GBP. And the thinking behind this is very simple. If inflation now comes in below expectation and below the forecast here of 2.5%, while it was 2.4% before, the thing is that the overall hawkish outlook, which was delivered by the Bank of England last week on Thursday during their meeting when they hiked rates by 25 basis points, would be countered to some extent, meaning they are quite hawkish in their statement, even though the inflation rate coming out below expectation makes it more unlikely that they will hike rates in the future, meaning that this could trigger further weakness into the GBP. So there's not only the significant breakout in the US dollar on the upside, but also there's some potential trigger events next week, in this case for GBP, which could trigger further weakness in this respective currency, coming together with US dollar strength, meaning pound sterling against US dollar probably vulnerable to further losses then, and the push down towards 125.50 to 126 here. That said, there's also a potential trigger event from an economic perspective, fundamental perspective, next week here in the Eurozone. So on Tuesday here, there's also the GDP growth rate release, which should be expected. And there's something really interesting. So if you look at those numbers alone, you can see that the previous numbers came in at 2.5%, while the forecast here can be found significantly below that, 2.1%. This is very interesting, in fact. So it shows that economists already expect the economy to slow down in the European Union. And now something really interesting happens. So there's a website out there which delivers free fundamental data on nearly every economy out there, every country out there. It's called tradingeconomics.com. It's completely for free, and I highly recommend it for everyone who wants to dig deeper into the topic of fundamental analysis, respectively, who wants to get a better overview on the latest data, which was published here on GDP growth, let's say for the Eurozone or whatever. And that's exactly what I did. So I went to Trading Economics. I searched for Euro area GDP annual growth rate. And what I found was, if you look at the last 5 years, you can see a clear uptrend here, which formed from a negative economic outlook that was around the Euro crisis, end of the Euro crisis. And then we started to push higher here towards 3%. But nevertheless, there's a clear sign of a top forming here. And this could mean that we are already seeing an acceleration here in terms of I'm missing the word. We are on a clear downturn here from an economic growth perspective. So such a development, if this plays out here and the market starts to really fear this downturn and starts to speculate that probably the ECB then will be more unlikely to hike rates in the second half of 2019. And so far, this is exactly what the market is playing right now. Probably seeing a rate hike only at the end of the second half of 2019, if at all. If such a development starts to form here, chances are good that euro could find another accelerator here on the downside and see some further weakness too. So it really currently really depends on whether the data, in my opinion, and whether the data around the Eurozone, respectively pound sterling for those two currencies against the US dollar, whether they can convince next week. If not, chances are very good that the market will see a further accelerator on the downside. So weakness in euro, respectively pound sterling, in combination with strength, current strength after the breakout in US dollar, which all in all means an acceleration in euro USD on the downside, respectively, and GBP USD on the downside. So that's it on the euro USD and on the GBP USD. Now there's also something very interesting happening right now. Currently, yes, the Japanese yen is losing some ground too, but nevertheless, compared to the euro, respectively to pound, the Japanese yen presents itself very, very strong, which is a clear sign, in my opinion, that there's potentially something forming like risk aversion. Something, by the way, we can already spot when looking at European equity markets. We'll have a look at the DAX in a few seconds. So this said, probably this is something interesting probably for those who are looking for or who are trading the weak strong part, let's call it. So looking for weak currencies, selling them while buying those showing currently strength. Sure, the US dollar is a good a strong currency right now, even though when looking at the relative performance of the Japanese yen against US dollar, Japanese yen seems to be stronger than the US dollar. While now looking back at the two currencies I just presented, euro and pound sterling being weak, probably euro Japanese yen and also pound sterling against the Japanese yen are two even more attractive options for those planning to probably also trade such a potential risk aversion forming into the markets and some negative or skepticism coming into the market. Let's put it that way. So in this context, very interesting levels to watch. In this case here for dollar Japanese yen is the region around 110.60 in my opinion. If we break below that, I think a further acceleration down towards 109.50 is likely. And probably also we can then start to talk about a short-term top forming here in dollar Japanese yen, which is also capable of moving dollar yen probably even lower towards 108. But this is a long way to go. I think next week, the key level here on the downside should be expected, can be found around 110.50, 110.60. We have already seen a test of this region in the morning. Let's see if there's another attack then in the next week of trading. Currently, I have to say that, by the way, into the weekly close now, I don't really expect huge volatility to come into the market, and this has something to do with the fact that volatility still is very, very low, and I have some doubts that really there could be an acceleration or a real risk aversion forming now into the weekly close in the US equity markets, which is probably a good positive sign for European equities, which have already seen some stronger pushes on the downside. Just look at this daily candle. This is well, I think it's probably it's difficult to say that it's not really life-threatening for the bulls, but we are about to enter a very, very critical region here. So after this push above the 200 simple moving average, which it's obviously a fake out, so we're incapable of making it back above that level, and now the weakness which came into the markets, and probably the main driver for this weakness, can be found in emerging markets. So look at what's currently happening in Turkish lira, for example. So US dollar Turkish lira just pushed to above 6. And if I'm not mistaken, I think the line in the sand for the banks and staying solvent before we definitely get to see a collapse of the banking sector in Turkey is around 710, I think. US dollar Turkish lira here, it's 710, I think. This is the line in the sand. This is the moment when there's no further FX reserves available anymore, and we should expect a collapse of the banking sector then in Turkey. So this said, but also the developments around the new sanctions from Washington against Russia, for example, the downturn in the Russian ruble right now. So emerging markets start to become a serious threat here for also the equity markets, and the push lower in the European equity markets in this case, and the DAX here, is definitely something to worry about, especially now entering the critical zone around 12,400 points. So if we make it below that level, probably it's even more significant, the region around 12,500, 530, which we already broke here in the morning. But with this in mind, that we are here currently trading in this zone, and that there's further potential and downside given, there's a good chance that next week there could be a test of the region around 12,100 to 130 points. So the advantage in the DAX here in the European equity markets should definitely and can be found on the short side here. And so also here, I think chances are very, very good that sell the bounce or intraday short engagements could turn out to be very, very profitable. The only thing probably currently holding the DAX slightly or stabilizing it, even though it's hard to say or talk about the stabilization. If you look at this development here, right from the start of the morning, the only thing currently holding the DAX is the weaker euro plus the low volatility in US equities here. Nevertheless, you can certainly feel that there is serious pressure forming. There's serious chances that we'll see a more significant push lower. By the way, in this context, it's worth mentioning that in the morning I retweeted an article from Zero Hedge, within which the very thin liquidity currently is made a topic. Interesting enough, I mean, we are not talking about something special in the time between July to August that liquidity dries out, because it's summertime, it's vacation time. So usually this is something you should expect. But the thing is that the market here, when looking at the volume currently, it shows that we are below average here. So the market environment is very, very, very thin. You can see this, by the way, when looking at the DAX, you see sharp spikes on the upside, you see sharp spikes on the downside, and we are aggressively bought back, aggressively sold back. Shortly after such pushes happened. Look at what happened yesterday here. Short spike on the upside, short spike on the downside, and back again. The same is happening here. Short on the downside, upside, push higher, push lower. And this choppy market environment in which we find ourselves here is certainly a sign of low liquidity. Why do I mention this? Well, because it's a serious threat for further losses. The moment we push lower, there's potentially no bids out there who can stabilize the market, which means we could find ourselves in a very dynamic and strongly accelerating move on the downside. And this means nothing more than in the DAX here. It could be that such a push towards 12,100 to 130 comes within one day, even though we're currently trading 300 points above that level. But nevertheless, the current developments show that there's some serious threat that further supply is given into the market. And if it really hits the market, probably there's no demand out there, at least stabilizing markets a little. This could drive equity markets sharply lower within probably seconds, let's say. So something to really think about, especially also when you're planning not to trade the short side, but probably you're saying, well, I don't share your view and I plan to trade the long side. That's completely fine. And I mean, we have seen it several times in the past that short spikes on the downside were aggressively bought back within no time. And from a risk reward perspective, sometimes it could be interesting. Nevertheless, please keep in mind that low liquidity in the market also increases the chances of facing slippage. Meaning, if you're trading alongside, make sure that you're working with a stop and take into account that you're probably getting slipped on the downside because there's not enough liquidity out there, which should usually result in a reduction of your position size before you enter such an anti-cyclical trade. So this is something, please, also to keep in mind. So risk everywhere somehow. So risk off, in fact, where it's a clear tendency of risk off. So now we are closing the cycle and coming finally to gold. One of my current really favorite markets I'm looking at, also not only from a research perspective, but also from a trading perspective, because I think that the risk reward for long engagements in gold is starting to become really, really, really interesting. So I've presented several thoughts already in the past. So it's not that it comes with a surprise to you that I'm positive for gold, but probably something entered my mind, which which let me come to the conclusion that probably building a long position is the right is the right move currently. First of all, let me just show you a pure technical indication that the momentum on the downside is obviously diminishing. Therefore, what we will do is we use an indicator which we call the RSI. It's a standard indicator, and it's an indicator which I usually use for spotting so-called divergences. So in this case, a bullish divergence. What is a bullish divergence? It's in fact very simple. We make lower lows here in the chart, as you can see, and obviously I don't need to draw it anymore because you can see it here with this lower trending channel line. And nevertheless, these lows are not supported anymore by the RSI, but we start to make higher highs here. So this is not a sign that the market will aggressively turn higher. That's not the case, because what you can see is that, for example, here, when looking at those developments at the midst of July, comparing these lower lows here to the lows here from the beginning of July, you can already spot such a divergence. Nevertheless, the market drifted lower from here too and made new lows. So this said, obviously, it doesn't necessarily mean that the market will sharply turn higher right after you spotted this divergence. Nevertheless, it's a sign that the market probably starts to find more and more a bottom here. Okay, so this is something which is really interesting. I combine this with something you can also see in the Commitment of Traders report, and something we already mentioned here before. I compare it with the current skepticism from a large speculative side, because what you can see is that currently the net long position here from big speculators is the least net long position since at least 1 year. So last time we saw such a low net long exposure here was in July 2017, but also here, for example, at the end of 2015, at the beginning of 2016, we've also seen this net long position staying at a very, very low level here, and then we saw in both cases a very sharp rise on the upside. So this is, from a sentiment perspective, now something which comes to your mind when you ask the question, okay, and where should the demand come from to result in a sharp rise here in the gold price? Well, it's in fact very simple. You should expect it from the speculative side to come here, that big speculators start to build back a net long, a more aggressive net long position in gold. So this is then the next thing to think about. And now, nevertheless, there's still a question. Okay, but this has developed now over weeks, so it doesn't necessarily mean that we are about to enter a very, very bullish phase here. And there's now something else coming in my mind, and something you will then, if you're interested in it, you can read it again here on the website from Admiral Markets on Monday in the traders blog. You will find those thoughts written down in a similar fashion as I did here for GBP CAD. So you don't need to copy paste this now. Since, by the way, the pattern I will just describe here will start from Tuesday onwards. So this is what I meant by I'm probably a little early with this long trade here. Nevertheless, I somehow feel that probably we're about to probably already see some kind of demand coming into the market, probably into the weekly close. And that's why I entered this trade already, to probably get an even better risk reward. But let's come back to the thoughts here, and I've prepared already an editor, and I want to copy paste my thoughts around this here. So let me do it that way. In 15 years. Okay, so the idea is it's gold seasonal long, and this is the time span. It's the 14th of August, so next week Tuesday starting, till the 7th of September, so nearly 1 month. And now the time span we are looking at here is covering the last 20 years. And in 15 of those years, so meaning a hit rate then of 15 divided by 20, which equals to 75%, average gain, gold traded higher. I'm sorry, this is, by the way, wrong. It's not lower, it's higher. That's something I have to change here. So the average gain is 27 USD per ounce, while the average loss within this time span has been 1470 USD per ounce. So here, the only problem is that the max drawdown, this is something to probably worry about a little, but nevertheless, something which is also, which you have to take into account, since you're clearly anti-cyclical if you're trading gold long right now. But it's 55.24 USD per ounce, probably something to take into account when setting your stop, even though you can already see it here. I'm working with a very, very aggressive stop, so slightly below the lows here. It's 1,203 in fact. This is the region around the current low, so I don't want to be positioned if the market makes new lows, and I don't want to work with a stop which is somewhere somewhere in the middle of nowhere, let's call it. So yeah, with this in mind, this period starts, as I was pointed out, that starts next week on Tuesday. And this is then something when I say, okay, well, there's now more and more signs that probably the momentum on the downside in gold is diminishing. The risk reward is, I think, very attractive. This is especially true if we are somehow capable of making it back above 1,235 USD per ounce. So this is the current region of this this last relative high here, which you can spot here. And so what we also know is that, for example, when looking at after sharp declines in gold, that there's no real looking back in gold. So what you can spot is, and this is the problem. So some of you probably might think now, okay, the idea is okay, that's a nice thought, and the risk reward is very attractive. Nevertheless, probably we should wait till gold really is forming a bottom here, and then starting to build a sequence of higher highs and higher lows, for example, let's say on the lower time frame, on the hourly chart. Only problem with that is that we have seen plenty of times when gold just took off after such a sharper drop here before. So that's not even as significant, this drop here, as it has been now from the highs of March. Nevertheless, you can see that gold just took off. There was no real pulling back on the lower time frame. Same is true here. So gold is just taking off, pushing higher. There's probably slight pushback. Sometimes you get lucky and get the fill. Nevertheless, let's say when you're looking for a retest of former highs which are building or something, but nevertheless, it's not unusual that gold just takes off sharply, pushing sharply higher every time after a sharper decline. And that's one of the reasons why I currently favor entering the market here, even though it's a very, very speculative entry, and even though we surely agree on the fact that we are aggressively entering the market, and it's a clear anti-cyclical environment in which we position ourselves. Nevertheless, I think from a risk-reward perspective, it's worth it. And again, gold starts to get really, really interesting. So it's I wouldn't call it excited about it, but nevertheless, I'm willing to enter the trade here, since I have somehow a strong opinion that gold could push higher from here. Yeah, the only thing I'm waiting for is a trigger, which could be risk aversion. You say, hey, if you're long gold, you can't be really long US dollar, since usually you have a negative correlation between those two markets. But the thing is that this is one of the reasons why I'm a little skeptical about the US dollar. I'm very positive for gold, and I could imagine gold to really push higher, significantly higher. And also what I'd like to mention is, after this break higher in the US dollar, or respectively push lower in Euro USD, push lower in GBP USD, I consider the performance of gold to be quite solid, because usually you'd expect a sharper decline in gold then, and we're trading in the range around 1,200 USD, so a level which can be considered a psychological level. And so interesting enough, I think gold can stabilize here, and this is some kind of at least a small sign of strength here. I'm smelling, and one other reason why I like gold here from this current level. And let's just see how things develop. So next week on Friday we have another week of trading after. We are looking back at another week of trading. Probably gold already decided in which direction it wants to push. Probably it's pushing higher. That would be welcomed from my end, especially. If it's pushing lower from here, okay, fair enough. Nevertheless, the picture stays interesting from a risk-reward perspective, and probably I'll give it another try then from a lower level. Yeah, and that's it so far from my end. I hope you enjoyed this webinar, and I'd really appreciate your feedback, hopefully positive feedback on YouTube, for example, with a thumbs up or something in the webinar channel, respectively YouTube channel from Admiral Markets. And from my end, I wish you all the best. Happy trading. Watch your stops. Enjoy yourself over the weekend, and talk to you again then next week. That's it from my end. So probably Tim wants to say goodbye too. I'm off for the weekend then. So have a nice one.
Thanks a lot for this amount of very interesting information here. Thanks all for all our listeners who are joining us here today. As Jens already said, next week we are back with the same webinar, and also you are for sure invited for our daily English webinar. It's called Real-Time Daily Trading Ideas. It's always like 12 p.m. EET. So if you check out what is going on daily, here Jens has a screen. Here you can see it. Real-time daily trading ideas. This is the exact name of our daily global webinar. So again, if you like, you've always invited for this one. All are totally free. So yes, for the moment, thanks everybody again. Have always good trade. Have a nice weekend. Enjoy your free time, hopefully, and we see us next week. Bye bye.